You might have heard this advice before. Refinance every few years to get a better deal. It sounds smart, right? But it's actually not as smart as you might think. The truth is, refinancing without a strategy can actually cost you more money. Because in New Zealand, the big banks usually have very similar interest rates. So switching banks just to chase a slightly lower interest rate, it doesn't actually do much for you. It doesn't cut decades off your mortgage and save you hundreds of thousands of dollars in mortgage interest as you would want to. The real reason refinancing can help you is not really the interest rates, it's the structure of your mortgage. When the structure improves, your mortgage can work harder. Your money, when you pay onto your mortgage, can work harder. You can pay more principal off faster, which means you're paying your mortgage for less time and you're paying less interest. So today you'll learn when refinancing actually makes sense. And at the end, I'll show you the hidden refinancing trap that can quietly add years to your mortgage and what to do instead. Now, most people think that refinancing is about getting a lower interest rate, but the real advantage is improving your loan structure, your repayment strategy, how your money flows, right? Without a strategy, refinancing is just switching banks to kind of get pretty much the same impact on your mortgage. With the strategy, you're actually able to use refinancing to reduce that interest rate faster and pay your mortgage off earlier. Okay, so here are some reasons for you to be able it makes good sense. It makes good sense to refinance. So number one is when you need better loan tools. So sometimes your current bank doesn't offer the loan products, that works best for your situation. A good example is offset accounts. You might want to use an offset loan because you like a bank account bucket system, managing your money with multiple bank accounts, and you have money sitting there. So you can use your savings and any cash you have in those accounts and offset against your mortgage. If your bank doesn't have that, then you might want to consider refinancing. There's only 3 banks currently while I'm recording this video that has offset loans, and that is BNZ, Westpac, and Kiwi Bank. And so if you're at any of the other banks and you think an offset might be best used for your situation, then you might want to go ahead and refinance to those banks to give you a better option for structure and may help your money work better for you and pay down that mortgage so much faster. The second reason that refinancing makes good sense is when you want to implement a faster mortgage strategy, paying your mortgage off decades early. So refinancing can help you to implement that mortgage debt reduction strategy. For example, being able to use revolving credits, offset accounts, splitting up your mortgage into multiple loans. These tools allow you to be able to have your everyday cash flow strategy, how you manage your money to help you to reduce your interest faster. And when the structure is right, then your mortgage can disappear, like I said, decades early. The third reason why you might want to refinance, and it makes really good sense, is when maybe you're moving from a second-tier lender. Many of you maybe got a mortgage because you wanted to be able to buy property, either your family home or a rental property. And the way to get there at that time was to go to a second-tier lender, which means it's not one of the main banks and their interest rates are a little bit higher. And so once your LVR, which means the amount of your mortgage has gone down, the value of your home has gone up, and now maybe you're at a good position to where you can refinance to a main bank for a lower interest rate. So that's a really good reason to be able to do that. The fourth reason that you might want to refinance, and it really makes good sense, is when your mortgage structure needs updating, right? So your financial life might change. You might have had a structure years ago that worked well for you then, but your life might have changed, your age and stage, and maybe you're getting older, you're moving towards, maybe you have more disposable income, so you want to change your structure to have an offset or revolving credit. Maybe you're moving towards retirement and you want to make sure that you're paying your mortgage off as fast as you can. So refinancing can allow you to restructure the loan so that your money works with your life at that point. Now you can also restructure, so talk to your mortgage advisor for what works best for you, restructuring at your current bank or refinancing to another. The last reason that refinancing makes good sense is if you need some financial relief. So you can, if life sends you a curveball, maybe you had a job loss or reduced income, or maybe your business has slowed down, maybe some unexpected financial pressure, and you have a good amount of equity in your home and you want to give yourself some financial relief on your mortgage repayments, you could refinance, move that mortgage out to 30 years, and that will lower your minimum repayment. Now, a caveat with this is I would only use it if it were a temporary strategy. You need temporary relief because obviously moving your mortgage out for 30 years is going to mean that you're going to be paying a mortgage for so much more time. And obviously, the goal is to be paying the least amount of time on your mortgage. But if you need that relief, then, that's a temporary strategy where you can do that. And using that along with your mortgage debt reduction strategy will then give you the peace of mind. Hey, look, right now I'm moving my mortgage term out to give some relief, but then I have a strategy that I can implement once times get better. Now, I said to stay until the end. I was going to give you the hidden refinancing trap. Okay. So here's the mistake that many homeowners make. They refinance to get a slightly lower interest rate, right? They go to a different bank and that bank resets the mortgage out back to 30 years. So imagine 2, 3, 4, 5 years later, you refinance again and you set the mortgage, that mortgage goes back to 30 years. You can end up stretching out your mortgage and you're paying that same mortgage 40, 50 years, right? So what to do instead is when you refinance, you can move it out to 30 years if you want to. Keep your repayment the same as it was previously if that's an option for you. Another option, what you can do is use a mortgage debt reduction strategy. So here at FutureBound, we teach the Freedom Blueprint where you're using your income to be able to pay lump sum payments on your mortgage every single year, and you're bringing that equity, skyrocketing in the equity because you're bringing that principal down super quickly. And so if you're using that type of strategy, moving your mortgage term when you refinance after 30 years doesn't make much of a difference because you already have a strategy that's reducing your interest way faster, right? If you're reducing that principal super fast because you're putting on that lump sum payment each year. So you're able to use the ability to pay more on your mortgage. So it doesn't really matter if you move that mortgage term out to 30 years, right? And it gives you a little bit of a fallback plan if you need a temporary relief, right? And so being able to, the key is to have a clear strategy when you're refinancing, making sure that you're not just chasing lower interest rates as if that's your primary strategy. You might save hundreds of dollars, maybe thousands of dollars, but what you don't know is you're leaving on the table hundreds of thousands of dollars that you could be saving by just using a mortgage debt reduction strategy like what we teach with our Freedom Blueprint here at FutureBound. So when you have control of the structure of your mortgage, you control how fast it disappears. And when you control your income, you control your future.